Welcome to the March monthly update. I'm joined by Sherelee van Rooyen. Sherelee, thanks so much for joining us.
Thank you. I'm excited to hear what you have to say today.
So I think we're in a bit of a crazy time. I think the world's definitely in a state of flux. We've got, at the start of the year, reserve banks doing their bit to slow down inflation, both in South Africa and around the world. And then a little bit of political uncertainty that suddenly becomes a major issue. And I think for a lot of us, this is a bit of a crazy time.
Yeah, and it's definitely something that I've experienced with clients too. Just the questions that I've had flowing in throughout the last week at least. And I think it would be very interesting to hear your thoughts on that.
Yeah, so I guess Ukraine's top of everyone's mind. And, I think one thing about a big political surprise like that is the ability to make predictions becomes almost zero. But the urge to make predictions is there. So we're going to see a lot of market commentators, I guess so-called market commentators, putting out very big, scary predictions and projections about what it's going to do to economic growth, what it's going to do to commodity prices, to inflation, to interest rates, to the dollar, to the rand, etc. And I think it's important to understand that the reason for a big shock like this will always be different, but the human behavior is always the same. So what do we see when we get a big shock or big surprise to investors is massive volatility in a very short space of time. So what we're going to see is the rand and the dollar and oil prices and gold prices all going crazy. And then after a while, that volatility starts to smooth out, because what happens is people stop reacting and stop being emotional about it. And they start to try and do some calculations, and they start to try and understand what's really going on. And part of that is going to be determined by what goes on in the Ukraine. So at the moment, we can't underestimate the human cost of this. I think we're not in any way diminishing that this is a tragedy on a human scale. And it's not our job as investors necessarily to disregard that. But what we have to say is, we can't invest according to a human tragedy. What we've got to do is look at this and say, what will it do for the prices of investments, and then make some calculated decisions around that. So we're not being cold or immune to what's going on a human level, but on a market level, at the moment, it's important to understand this is an invasion, it's not a war. And I think that's the thing that we need to realize is this is not the Americans flying in bombers to go and fight Russian bombers. This is the Russians invading a country, and the morals of that are awful, but it's not a big war yet. Let's hope it doesn't unfold that way. So what we've seen in the early days, and at the time of recording, this is very early days, is a ramping up of sanctions, and that's a big issue. It might cause commodity prices to rise. We don't know yet, and I think that's the point, is that the short term, yes, commodity prices might rise. Long term, we don't know. And it's important, we need to be humble enough to say we don't know. All of us, the markets around the world, investors and commentators need to say that. We are reacting to things that are unfolding in real time. And I think that's the key here. So when someone says to me, what do I do about the Ukraine? Surely the oil price is going to rocket, and surely the gold price is going to rocket, and shares are going to collapse, and the dollar is going to rise. That's the kind of common theme. Well, what's interesting is day one, oil prices did rise. So did the price of gold, and share prices did fall. Day two, the opposite happened. So be careful now that when you're making investment decisions, you're basing on predictions. And when you make a prediction, what you've got to do is you've got to predict the event. In other words, you've got to say, I predict oil prices are going to go up. Then you've got to predict what everyone else is going to do. And then you've got to make an investment decision according to what you think other people are thinking. That's kind of impossible. I can't even tell what you're thinking, and you're sitting right here. So how are we going to predict what people around the world are thinking? So be careful of this, because there might be a lot of hedge fund and derivative movements in the prices of all of these investments. So what you might find is share prices rising, not because investors think the world's in a better place, but because they have to close off what are called short positions, where they felt the world was going to be much worse and it wasn't as bad as they thought. Now they've got to unwind those derivative positions, and it causes prices to rise. So really, I can't urge people strongly enough to say, just take your time, breathe, think about this, and stick to your overall recommended asset allocation and your overall recommended investment strategy. We built those strategies to cater for massive volatility. We didn't know, and there's no way we're claiming credit that we knew Putin was going to invade the Ukraine. What we did do is we built your investment strategy so that you could tolerate these kinds of shocks, because the likelihood is it causes major uncertainty, lots of scary noise and news, and then it smooths itself out once the markets start to price this. And I think in a very long answer to your short question, that's what I think is happening now, is too much reaction, not enough logic, and it's our job to be logical in times like this as much as possible, and to help people make sensible financial decisions when the times aren't sensible. And we think the best thing to do now is sit on your hands. If you've got a good strategy already, stay with that strategy. It's designed for this. If you need to make major decisions because your own life has changed, that's a different story. Then we're going to ask you to contact us. But if life's going according to plan, this is not going according to plan at the moment, but the plan does cater for this kind of volatility.
Yeah, and I guess just to stay focused on what you can control, because right now there's a lot that's going on that we know that we don't know what's going to happen, number one, and that we definitely can't control.
Yeah, and I think, that's a great point, is that the variables that we can control are our decisions, how we spend, what we earn sometimes, and then how we allocate our assets across the cash, bonds, property, shares. If we've got that right, don't worry about the rest. You can't control it, you can't do anything about it.
Yeah, and I think maybe to add to that, we don't really make decisions from our perspective now and changes to, let's say, the exchange rate or phase-in periods just based on the short-term factors that we know of today. We will take time if those things do change, but right now I think that's just important to highlight that, it's to send money offshore, although it's scary right now, if clients still have a decision to make. We haven't changed our view on the rate to the dollar, which is still at or below 15.50 to the dollar, and our phase-ins will be client dependent to a certain extent, whether they invest in locally or offshore. But again, we're not making big calls right now while things are so uncertain.
Absolutely, and I think still, if you had to ask me what are the biggest risks to moving markets now, knowing what we know right now with the war and everything going on, it will still be irrational actions by reserve banks. It's not going to be the political crisis in the Ukraine and at the moment, knowing what we know today. If it changes where the Russians move further into Europe than the Ukraine, that would have a big impact. But for now, we think it's relatively contained, and so what we're much more worried about are reserve banks around the world pushing up interest rates too quickly, economy slowing too fast. So there is a bigger tide moving here than the small wave of the Ukraine. And importantly, I know I've said it before, but we're not discounting the human crisis. It's massive for the people there and their neighbors, where they are going to be flooded with refugees. But ultimately, it's about the economic impact of that. And at the moment, it's still muted.
Okay. And I guess bringing it back to our local kind of side of things is just really around the budget speech in February. And I think that for us was also a key focus point as a business. I know one of the things that Theo said was that it was a really investor-friendly budget. And I think we saw some of that coming through with what was mentioned. One of the things being possible changes then in March to Regulation 28.
Absolutely.
Which is really what gives the guidance on the limits and the like in retirement funds. So from that perspective, they are wanting to actually increase the offshore exposure allowance in retirement funds. They mentioned 45%, which includes a 10% allocation to Africa specifically, which then means anything outside of Africa, they would like to increase from 30% to 35% in these retirement funds. What are your thoughts on that, and any other key takeaways from the budget speech?
I think it's a big number, so it's important to understand in the South African context, retirement funds are the £1,000 gorilla in investment markets. The PIC by far is the biggest investor in the country. And so when you look at the rest of retirement funds, they're also massive. And so increasing their offshore allocation from 30 to 35% is a very noticeable, very material relaxation of exchange controls in terms of size of assets. And I think it's a massive signal, but it is also a big relaxation. So I think that it's important that we understand Treasury are listening to what investors are asking for, because investors feel constrained when they can't allocate money how they want to. And so it's been a disincentive for a lot of people to put money in retirement funds because of this artificial restriction on offshore allocation. So I think it's a big step. And it's being done at a time when the South African economy is not doing well, when investors would like more money going into shares, especially Treasury. And so to see this move, which might seem counterproductive right now, I think is a great move, because what it's doing is it's relaxing things more. And the fewer restrictions you create on investors, the more they'll move money in and out as they see fit. So I think it's a huge signal. And I think it's a sign of things to come. The other big one then would be the drop in company tax rates. Yes. So we go from 28 to 27%. People will say, well, that's, it's a small reduction in taxes actually, and it won't be a big loss to the fiscus in terms of actual cash that will be sacrificed. But I think it's a huge signal. The minister was at pains to speak about that tax rates in South Africa are very high for companies and individuals. So if we get some economic growth, what we will see is that tax rates will go down further. Again, it's about the signal as well as the action. And in a time when there was huge pressure on the government to increase social spending, to increase social grants and all of those things, we see a cap on social grants. We don't see a big increase, and we see a reduction in tax rates. So all the time, what we're seeing here are big signals from government saying this is a business-friendly, investor-friendly budget. That's not because they want to make investors rich. What they're saying is they're recognizing business is the place that creates jobs, business is the place that creates economy. What government needs to do is create an enabling environment. And one of those things is reduce tax rates and give businesses incentive to invest and grow their profits. And that will be good for employment. It'll be good for everybody across the country. So I think it was a massive signal event. It wasn't just a small reduction in tax. I think the other thing would be the no fuel levy increase and no road accident fund levy increase. Again, it's a signal by government saying we know you're overtaxed, and when we can and we will reduce those taxes across the board. So I think the last comment from my side here is we've had so many scary predictions from fearmongers about there's going to be prescribed assets, which was effectively a nationalization of retirement funds. We're going to see personal taxes go up. We're going to see exchange controls being tightened, not relaxed. We're going to see VAT going up. None of that happened. And we've been saying it won't happen, not because we're big predictors, but because we believe the government is pretty rational in these times, and we believe the predictors and the fearmongers are irrational. They're selling a scary story to drive their own agenda. And it's a reinforcement to say, we think you should ignore those people that were telling you to cash in your retirement funds, to send money overseas at any exchange rate. People who followed that advice lost the 30% jump in the JSE, they lost the strengthening of the rand, and they paid massive taxes. It was a really bad decision, and it was driven by people with their own agenda. So once again, stick to your course, stay true to what you're supposed to do, because it will work out for you in the long term. It's not just a one-way bet against the rand, against the JSE, and against emerging markets. The story does turn, and we are living that story right now.
And I think if there's any big concerns from our clients, it's just to contact us and always talk it through with us before making any decisions. And we're always here as well to talk through these big things that can impact your daily life.
We might not get every decision right, but I think what's important about that is we get collectively, between us and our clients, if we can get most of the decisions mostly right most of the time, we're achieving the objective, because investments is not an exact science. So it's impossible to aim for perfection with your decisions. And so, as you say, give us a call. Let's talk it through. Sometimes that's all you need. It's just an objective voice to help you. And sometimes it's a case to say, hang on, your situation has changed. Yes, we do need to change your strategy. But it won't be based on what's going on out in the world in the next day or two. It'll be based on long-term trends.
Yeah. Thank you, Warren.
Thanks, Sherelee.